Hello my dear friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about junk bonds. The term junk bonds would be a new concept for many of you. So in this lecture we would be discussing about junk bonds. We will look into what are the features of junk bonds and how it is different from other kinds of bonds. A very interesting topic, but before we begin, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations including SSC and bank courses, UPSC optionals, SSC JE courses, teaching examination, railway examination, defense examination, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT exams for various state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details, or you can call to any of these numbers for more information. So let us begin. Let us first understand what is meant by junk bonds. So junk bonds, which would be a very new term for many of you, it's very simple concept. It is a bond that carry a higher risk of default than the normal bonds. So normal bonds can be issued by corporations, businesses, or even by the government. So normal bonds also carry certain risk, but the risk of junk bonds would be higher compared to the normal bonds. The risk of default for the junk bonds are higher. So whenever you hear the term junk bond, you should remember that the risk factor or the level of risk is very high for junk bonds compared to normal bonds, and such type of terms are very important for your UPSC examinations and also other exams like the RBI, SEBI, etc. Because if we look into some previous year papers, we will see that there were questions that was related to certain concepts like junk bonds. Now if you look at the previous year question of UPSC, where UPSC asked what is masala bond and you were given 4 options, you had to pick up the right answer from the 4 options. So during the year 2016, when UPSC asked you a question regarding masala bond, it was also not a very familiar term to many of you. Like that, junk bond is also a new term that has been evolving now, and there are chances that UPSC or RBI or SEBI exams will ask you certain questions regarding the concept of junk bond. So remember, junk bonds carry higher risk of default than normal bonds. Now, what is meant by a bond or a normal bond? Bond is a debt instrument. Basically, you should understand that bonds are debt instruments. So what is the difference between debt instruments and equity instruments? Equity instruments means an investor is purchasing the part of a share of a company. So you are purchasing the ownership right of a company under equity shares. Whereas under debt instruments, an investor is only providing certain capital or funds to the company instead of purchasing the shares of the company. Here the relationship between the company and the investor is only that of a debtor-creditor relationship. Whereas in equity, the relationship is that of an owner and the company relationship. So bond is a debt instrument, very important. It is not an equity instrument, but it is a debt instrument. And what is the speciality of a debt instrument? Under the debt instrument, the investors are paid interest. So interest is a return that you get for your bond. Whereas in equity, you will not get any interest, but you will get the profit or the share of the profit of the company. Now, the junk bonds are issued by those companies or corporates that are financially struggling, and also those companies that have a higher risk of making the defaults in the interest payments. So such type of bonds are classified as junk bonds. So as we said, bonds are fixed income debt instruments that corporations or government issue to raise capital from the investors. So when the investors buy the bonds, they are effectively loaning or giving loans to the issuer who promises to repay the money on a specific date, and this date is called a maturity date. And at the maturity date, the investor is repaid the principal amount plus the interest. And most bonds pay investors an annual interest rate during the life period of the bond, and this is called coupon rate. So these terms are very important. Coupon rate refers to the rate of interest, and maturity period means the date at which the bond acquires maturity. So these are all very important terms. Now to make it clear, an example, a bond that has a 5% annual coupon rate, that is interest rate, means that the investor who purchases the bond earns 5% every year. So this is the return on investment, and at maturity he will receive the principal amount also. Now hope the concept of bond, junk bond and maturity date or coupon rate is clear to you. Now moving on, let us understand what would be the yield for junk bonds. So we have seen that the risk is more with the junk bonds. So whenever there is a more risk factor, the yields will be more. So risk and yields are associated to each other. So a bond that has high risk will have more yields or returns also. So we have seen junk bonds are issued by those corporates or companies that are struggling financially. So this can be startups. They may not have enough capital to start their business, or those companies that are struggling financially on their midway. So these bonds carry huge risk, and therefore the yield on these bonds are also very high. And those companies that are issuing the junk bonds are willing to pay higher yield because they need investors, or they need to attract the investors to fund their operations, and therefore the junk bonds are also called high yield bonds. So other name of junk bonds is high yield bonds, and this is because the higher yield is needed to help offset any risk of default. Now let us look into the positives or the pros of junk bonds. So as we said, junk bonds have higher risk, therefore the return on these bonds are very high. So they offer high return or higher yield compared to other fixed income debt securities. And the junk bonds also have the potential of significant price increases as the company's financial situation improves. So there is always a potential for price increase, because by capitalizing the company, the financial situation of the company can improve, and this can raise the price of the bonds. And thirdly, the junk bonds also serve as a risk indicator of when the investors are willing to take on risk or avoid risk in the market. Suppose if the issuance of junk bonds are very high in the market, it indicates that investors are willing to take risk. Now if the issuance of junk bonds are very low in the market, it indicates that the investors are not ready to take up risk. So this will give a clear market indication on how investors are responding to risk in the market. So these are the positives of the junk bonds. Now moving on to the cons or the negative aspects of it. As we discussed from the beginning of this lecture, they are high risk bonds or high risk investments. Therefore, the default possibility of the principal amount and the interest or the return is very high for the junk bonds. And the junk bonds can also exhibit certain amount of volatility due to the uncertainty surrounding the issuer's financial performance. So there is always an uncertainty, and therefore it is volatile. And thirdly, active junk bond markets can indicate an overbought market, meaning that the investors are too complacent with risk and may lead to market downturns. So this can also lead to market downturns. Now let us understand how does a junk bond act as a market indicator, or how does it help understand the sentiments of the market. Now, some investors will buy junk bonds to profit from potential price rise. So we have seen there is a potential of price rise for the junk bonds. So some investors will keep in mind the potential for price rise, and they will purchase or buy the junk bonds. And as a result of this, increased buying interest of junk bonds serves as a market indicator or a market risk indicator for some investors. If investors are buying junk bonds, market participants are willing to take on more and more risk due to the perceived improving economy. Now, if there are only lesser sale of junk bonds, it means that the investors are opting for more secure and stable investments. And by this way, it is very easy to understand the sentiments of the investors, whether they are ready to invest in risky assets or whether they are willing to take up risk in case of bonds or making investments. And what is more important about junk bonds is that the junk bonds have much larger price swings or fluctuations in prices than bonds of higher quality. So those investors who are willing to buy the junk bonds, they can either purchase the junk bonds individually through a broker, or invest in junk bond funds managed by professional portfolio managers, same like the mutual funds. So these are the options. Now what are the possibilities or what can happen after the purchase of the junk bonds? So there are two options. The financial situation of the company can improve or the financial situation will be the same or will go down. So if suppose the company that issues a junk bond, after issuing junk bond, if the company is able to raise some finance and invest in the company, and if they are able to make the situation better, if the financial performance of the company improves, the price of the bonds will rise, and as a result of that, investors will flood in or many more investors will come up, and this will also lead to increased credit ratings for the company's bonds. And suppose the other happens, that means if there is still financial issues within the company even after raising such type of bonds, the credit ratings will go further down, the buyers will back off, no more investors will come in, and the existing investors, they will be at loss, they will not get their principal or the interest back, and this will add on to the risk of the investors and the performance of the company. So this is about junk bonds. You can find the PDF of this lecture on my Facebook page. You can also follow my Facebook page for more video updates, and please write to me at joycey.studyiq@gmail.com for any of your queries or clarifications. Thank you.